Good afternoon, everyone, and welcome to today's webinar on financial planning. Financial planning, it's a dynamic and ongoing process that adapts to the evolving needs and circumstances of individuals and organizations. By taking a holistic approach and considering all relevant financial aspects, effective financial planning helps to navigate challenges and achieve financial success. It is a comprehensive process that involves setting specific financial goals, developing strategies to achieve those goals, and implementing plans to manage resources effectively. It encompasses various aspects of personal or organizational finance, aiming to optimize financial outcomes and ensure long term financial well being. The key elements of financial planning are goal setting, budgeting, savings, investing, debt management, insurance, etc. Without further ado, let me take this opportunity to introduce the speaker of the webinar, Mr. Amit Trivedi. Mr. Amit Trivedi is the co-founder of Asset Knowledge Private Limited. He is having more than 30 years of professional experience in capital markets. He has trained more than 3 lakh participants through over 1600 workshops. Participants include employees of regulatory bodies, employees of AMCs, insurance companies, banks, MFTs, RIS, students, and general public. He has written over 1,000 articles for mainstream media. He has also involved in various projects with National Institute of Securities Markets, including development of certification programs for the intermediaries. On the examination committee for the NISM Series 10A, Series 10B, and Series 17 certification examination. He is also a guest faculty at NISM. With these words, I welcome you, sir, and over to you.
Thanks, Neha, and good evening to everybody. Neha put a very nice explanation to the topic of the day. Covered the scope to an extent. We're going to take it further from here. We'll develop on this concept further. But before we get into what financial planning, or we talk about financial planning, let's start with the other side of it. What financial planning is not. Because a lot of times we hear from many that I've done something, my financial plan is done. My financial planning is done. I've done something else, my financial planning is done. So let's straight away hit that point. Financial planning is not only tax planning, it is not only investment management, and it is not only insurance planning. While each of these are part of the financial planning process, by itself, none of it is financial planning entire. As Neha was mentioning, it's a much more wider and holistic concept. And apart from these three, the scope covers many other areas as well. And that's where, the way to look at financial planning, and I'm only going to restrict this discussion today to personal financial planning and not corporate financial planning or institutional financial planning. It is all about an individual or a family's finances. It is also called personal financial planning. And from that point of view, the way to look at this entire subject of financial planning would go something like this. It's about ensuring that a family has, number one, adequate income or resources. Number two, available in time to meet current and future expenses in line with, number three, one's needs. So the three underlying words are very critical, and it starts with one's needs, the family's requirements. Then to meet those needs or meet those requirements, the money that is required should be adequate and it should be available in time or at the time of that need. A delay in availability of that money does not serve the purpose. And these three are critical elements. And if we look at the whole subject in this manner, then we are actually looking at the cash flows involved in the financial life. there are some cash inflows and there are some cash outflows. Money comes and money goes. And how do we manage the whole situation in such a manner that this asynchronous flow of money, inflows and outflows, are generally not aligned to each other? How do we manage such that when we need money, it is available? The areas that we typically cover in the whole subject of financial planning would start with the short-term and long-term cash flow management, more about the regular income and regular expenses, and how do you budget, how do you allocate money towards various expenses. Only a few days back, the finance minister presented union budget, and we hear a lot of discussion about that union budget. Those of you who watched that or who observed that budget, primarily it's all about presenting a picture of the government's finances. Where will the money come from and where will the money go? And that where will the money go is all about allocating money towards various objectives that the government has. So if the government has infrastructure development as one of the objectives, money would be allocated towards infrastructure. If government wants to develop rural India, then money would be allocated towards that. Exactly in a similar manner, budgeting is done for various needs of ours. To begin with, we live in a house. The house may be owned or on rent. If it is on rent, then we have to allocate some part of our monthly budget towards house rent. If it is owned and if it is on loan, then there has to be an allocation towards repayment of EMIs. That's the beginning. Then comes the question of what are the risks involved in personal finance context. And when we talk about personal finance context, the risks are all about sudden expenses or sudden stoppage of income or sudden disruption in the income. When the income stops or reduces for whatever reason, what is the backup provision? How do we manage that risk? And for that, there are certain financial products available, popularly called insurance. We'll go into details in that. Now, when we've taken loans, the loans need to be serviced. Either you pay interest or you pay EMI. And if you paid interest, then at the end of the period, you pay the principal also back. If the debt is too much, then ability to service goes down dramatically. And in such cases, the entire debt portfolio or the loans portfolio or the borrowings need to be restructured. And sometimes a family may need to go to a debt counselor for help. Investments are a very interesting area, probably the most interesting part of the entire process of financial planning, because there is sometimes thrill involved. Some of the things, barring the budgeting, uh, the other things don't happen that regularly. The most frequent after regular expenses is likely to be your investments. And so much is happening around that the mind may waver from one investment to the other, one market to the other, one high to one low to one high. And in this situation, the way we manage our investments could be at risk of our mistakes. But is that a better approach, or is there an approach that one must consider? We'll touch upon that a little later, but management of investments, planning of investments And while we were earlier talking about allocation of budget towards expenses, when we talk about investments, it is about allocating money towards various investment options or asset categories, and that process is called asset allocation. One of the major requirements for all the people who are earning is to plan for a life when one stops working or retires from work. That entirely becomes a different subject altogether. Apart from that, at each stage, there could be some taxes involved, or there could be some provisions which may help us to reduce the tax liability or tax incidence. Sometimes the taxes could be higher and some other choice may reduce the tax burden. This tax planning needs to be built into the entire cash flow management, risk management, debt management, investment planning, and retirement planning. Having said that, a lot of times people start with tax management and then choose investments and insurance policies and stuff like that in line with the tax saving objective. The ideal approach is to start with budget, risk management, debt management, investment, retirement planning, and then find out tax efficiency or tax saving options there. And finally, when a person dies, the estate, the assets need to be transferred to the next generation or whoever the person wants to. How does that transition happen smoothly is part of estate planning. How do we ensure that there are less procedural hiccups? At the same time, even when the person is alive, but for some reason is incapacitated, could be a major illness, could be accident. In such a situation, while the investments and bank balance may be healthy, but how do we access that money to, if nothing else, at least fund the treatment of the person? That's where the estate planning subject comes in. So if you see, the scope is right from day-to-day life to even passing on to the next generation. And that's really how comprehensive financial planning can get. In a nutshell, financial planning is really about choosing the kind of life that you want to live and having a plan to use available resources, financial resources, to live that life. And that really is financial planning. Now, if you look at this subject in this manner, then the perspective appears to be quite different. It's not really so much about money, while money is a very important component, but it's not the primary objective. Money in this equation becomes means to an end, and that end is really the quality of life that you want. And this life will have these kind of questions. Many of these questions are, I mean, these are just some 6-7 examples. There could be many more other than over and above this. But these are the type of questions that one has to consider. And these questions, when answered properly, reflect your view about the kind of life that you want to live. Let's, pick up a couple of points out of this. First of all, the kind of house that you want to live in. In the slide, you will see buying a house, but it could actually be living in a good house. So the locality, the size of the house, whether it's an apartment block or a tenement or whatever, all these things will impact the amount of money required. But at the same time, you also have a choice of putting your own money entirely to buy that house, or taking a loan to buy that house and only put down payment, or take a house on rent. And in all the cases, the financial implications are going to be very, very different. How do you take that decision? And this decision is about whether you want to live closer to your workplace, or whether you want to go back to your native place and live there, or you want to live in a hill station, or where exactly do you want to live, what kind of quality of life that you're seeking. Second box shows two interesting points: education and marriage. Now, this marriage is an interesting thing. Incidentally, it's possible to get married without spending a rupee. But when I think as a parent, in my mind, I would not be planning that I don't want to spend a single rupee on my on the wedding when my children get married. As a parent, I may not want to think in that manner. A lot of times in many discussions, we come up with certain opinions. And one of the opinions that I've commonly come across is, between education and marriage, a lot of people think that education is far more important than marriage. Well, that's opinion of some people. And I'm not even judging whether that opinion is correct or not, and I'm not sharing my opinion with you. But the observation suggests that when financial advisors have discussed with their clients about these two goals, on an average, the money allocated towards marriage is 3 times the money allocated for education. 3 times. Now, somebody may simply criticize it. Somebody may say, yeah, that's natural. Somebody may be indifferent. But whose choice is it to allocate how much money towards what? It is that family's choice, because it is that family's life. And this is where goals become unique to different families. Each family will have different requirements, different goals. And that's why this subject is also called personal finance. Right? It's to each person his or her own. And from that point of view, because the requirements are unique, the advice also has to be customized or unique or different. A common advice applicable to everybody is a misnomer. And this point should not be forgotten at all costs. Well, then there are other matters that are mentioned out here. For example, any unforeseen situation or death of a bread earner. If you want to start a business, where do you get money from? How much money do you get from? Is also built into this. And especially because we're on this topic, and we've got quite a good number of people who joined. My simple request to all of you would be, those of you who are thinking of starting your own business, please maintain the discipline of keeping your personal finances and business finances separate. Otherwise, one area would transfer to the other and spoil both lives. A lot of times, entrepreneurs or startups mix up the family finances and business finances, and then the stress goes up. The support of the family also starts to come down, because now you're impacting their life for something that did not work on this side. It's always recommended, keep the two separate. Both would require different plans. Both would require different capital allocation. but have two separate plans, keep the finances separate. So while we've talked a lot about some of the points, some of the questions, let's now turn to the tool, the means to the end, which is money. And money, in whatever context you see, whether it is the businesses finances, whether it is the finances of government, or you are looking at finances of an individual or a family, these are the four pillars: assets, liabilities, income, and expenses. Let's first look at the components of each of the four. When you look at assets, the subject of accounting says that what you own is an asset and what you owe to somebody is a liability. And that's a beautiful explanation, very easy to remember, easy to understand. But if I were to look at the owned assets of mine, I must divide the assets into two separate categories when I'm looking at the subject of personal finance management or personal financial planning. And the way I would divide is, some of the assets are consumption items. I need those items for my regular life. I'm consuming those things on a regular basis. And the second category would be my investment items or investment assets. Now, the investment assets are something that I have bought for some purpose later in future, whereas the consumption assets are those which I'm using right away. Take, for example, the house that I live in, assuming that it's an owned house, the house that I live in is my consumption item, consumption asset. While it's an asset, but I'm using it. If I want to treat that as an investment, then I should be able to generate cash out of that house. And how do you generate cash out of the house? Either you give part of the house to somebody on rent, or you sell it off. In either ways, I lose that house and I need an alternative to live my life. The vehicle that I use for commuting regularly from home to office or wherever is a consumption asset. But a car that I have, which I run as a taxi, that becomes my actually business asset, but you can call it investment asset. The house that I have bought and given on rent to somebody, I'm not living there, that's my investment. So very fine line between these two, but important to divide between consumption assets and investment assets. Income. I mean, you don't need a definition for income, but the two categories are, one is active income, the other is passive income. The active income is one where you will earn only when you work. So your human qualities are utilized to deliver something, and in return for that, you get some money. So it is salary income for employees, whether it is professional fees for a professional. These are sources of active income or examples of active income. What is a passive income? A passive income is one where the person may or may not be present at work and still the income continues. All my investments are my passive, can generate my passive income. So if I put money in a bank deposit, the interest is a passive income. I don't have to do anything after putting a deposit. When it comes to expenses, expenses can be classified in multiple ways. The immediate expenses are popularly called expenses, but all the future expenses, there is another name all the future expenses are popularly called financial goals. If I want to buy a house 5 years from now, or if I want to buy a vehicle for my son 3 months from now, those become my future expenses, and those are my financial goals. So one, expenses can be divided in terms of timeline. The second division is some expenses are discretionary and some are mandatory. Once again, if I have school going kids, the fees that I have to pay is a mandatory expense. I can't use discretion once they have been admitted in the school. I may use a discretion of choosing a school with low fees or high fees, but once they've entered the school, it becomes a mandatory expense. The electricity bill that I pay for my house is a mandatory expense. But going out to a restaurant for lavish dinner is a discretionary expense. Watching 3 movies in a theater every month is a discretionary expense. Now, the difference between mandatory and discretionary is you don't have much room to reduce the mandatory expenses, but you can do a lot with the discretionary expense. One of the very popular sayings attributed to Warren Buffett is, don't invest what is left after spending. Spend what is left after investing. Very powerful line, very catchy phrase, and very wise, counsel. But what he means about that spending part is not the mandatory expenses. He is referring to the discretionary expenses. You don't have a choice on mandatory expenses, so don't really bother about it. They have to be planned for. They have to be incurred. Discretionary is where you can do a lot. And that brings us to the fourth pillar, which is liabilities or the loans. Be careful when you take loans, because loans would generate expenses in future, either in form of interest payment and principal repayment, or EMIs on a regular basis, which again is a combination of interest and principal. Loan means money is available now, but you have to pay back in future with interest. So you may in your mind evaluate whether the loan that you are taking is a good loan or a bad loan. And there could be multiple ways of looking at that. I'll just share my way of looking at good loans versus bad loans. When you take a loan to either reduce some kind of expenses or increase potential income, then it's a good loan. Either you are increasing potential income or reducing expenses, it's a good loan. But if you are increasing future expenses, that's a bad loan. I'll give you a few examples also on that, but just keep this in mind at this juncture. Having said that, if there is an emergency situation and other means of money are not available, then taking a loan becomes essential. And at that point in time, no need to worry whether it's a good loan or bad loan. Take, for example, during the COVID period, some families had to borrow money to pay for the treatment of their family member. That is an essential loan. There is nothing good or bad about it. You don't really need to do calculations there. Your objective is to save a life in the family. So let's now come to, having taken that out. Now let's come to good loans versus bad loans. When I'm taking an education loan, that education has the potential to give my children a degree, a skill set, some knowledge which can enhance their earning potential in future. That's an education loan which has the potential to increase income. If I'm living in a rented house and I take a home loan to have my own house, I'm reducing an expense called rent, but at the same time, I'm moving in a house which gives me comfort, because when I'm living on rent, there is a fear that one day the owner of the house may give me a notice to vacate the house, and then again I'll have to do house hunting. That may be a good loan. But when I'm taking a loan to go for a vacation, then evaluate whether you really need that vacation or not. Because what it means is I'm going on a vacation for which I don't have money right now, and hence I'm taking a loan which I have to pay back with interest sometime in future. So the money I don't have, I'll have to pay back more than that in future. Just think about it. So there are a few examples, and some of the ways you evaluate these four pillars. But these four pillars have an interlinkage. Income minus expense would generate savings. If that number is positive, which means your income is more than your expenses, then either you can generate assets or you can reduce liabilities. When income is more than expense, you can either create investments or assets, or you can reduce liability. But if the income is less than expenses, you have to either take money out of your investments or borrow money and create liability. Assets, especially the investment assets, not the consumption assets. Investment assets have the potential to generate income. Liabilities, all liabilities will generate future expenses. And focus on the language also, and deliberately I'm using these kind of sentences. Investment assets have the potential to generate income, no guarantee, but liabilities will generate expenses in future. But the interesting one comes in this relation. Assets minus liabilities is the net worth, and that net worth is the wealth of a person or a family or a company. And in majority of the cases, the objective should be to see that the wealth is increasing. From there, let's move on to the next point, which is about what we can call the cash flow of life. In a way, the whole thing can be explained through this diagram. Hey, by the way, some of you had put the comments that my voice was cracking. Has it become better now? If somebody can just please confirm whether it is, I just saw this messages now.
So it's breaking.
Even now it's breaking?
Yes, sir.
Okay, so just give me a minute. I'll change the internet connection. I'll change the network.
Okay, sir.
Okay, is it better now? Okay, thank you. Yeah, there was no voice in the interim because I was changing the connection. So, okay. I'm so sorry for this. But let's continue. Now, this diagram, I call it the cash flow of life. And, when we start working wherever, after education, we start working, and then what we get first is called the income. And I've used the word income from occupation. Right. So income from occupation means whether it is salary. If I started my business, it could be profits coming from the business or dividends that I'm taking out of my business. But that is the active income or the income coming from occupation. This income minus my regular household expenses, the mandatory expenses that we just discussed some time back, would make my savings. This savings, because there is no need currently, they are invested. And these investments have the potential to generate some income. So this becomes the investment income. So there is a active income, there is an active income, there is a passive income. These investments are to be made for some financial goals. And till the time the financial goals don't come, the income gets reinvested, and that's where you keep getting reinvestment of earning and reinvestment of earning and earning on that, and that is nothing but the compounding effect. Now, if you simply look at this entire diagram, how each item can be, looked at. So let's start with the two sources of income. Income, which is the passive kind, which is coming from investments, and the active kind, which is coming from what work we do. Now, between the two, and you can do this calculation for yourself, and barring a few exceptions, in almost all cases, well, if you are in working age group, in almost all cases, the active income is going to be much larger than the passive income. So let's do a mental exercise. If my annual income is X amount of rupees, and each one knows one's own income, let's call it X amount. How much money would I need in my investments such that the investment income becomes more than X? And let's not get into higher percentages. Just assume that all your investments are in a bank fixed deposit, so earning roughly 7 to 8%. How much money would be required in your investments, and how many of you are somewhere close to that amount? Right. So if I take 8% as my interest income, then what I need is that my annual salary income multiplied by 12 and a half. Right. So if I got 12 and a half rupees at 8%, I'll get 1 rupee worth of income. And if that's the case, if your active income is bigger between the two, then there is a need to protect that first. Protect against what? Protect against various risks. And what are these risks? And these risks are the 3Ds: death, disease, disability. And the fourth risk is loss of job or business closing down. Loss of job must be read in that context. Incidentally, for the 3Ds, the risks associated with death, disease, and disability, or the earning member's death, would mean that the family's income goes down to that extent. If the family member gets disabled and can't work, the income goes down. Against death, disease, and disability, a financial instrument is available, and that is called insurance. So you've got life insurance to cover loss of income on account of death of the earning member. You've got health insurance to cover expenses to be incurred on account of hospitalization, and you've got disability insurance also. Along with disease, the medical insurance, you also consider the critical illness insurance. So these three risks can be covered through a financial instrument called insurance. The fourth risk cannot be covered through a financial product, loss of job, except in certain rare cases like director's liability and stuff like that. But otherwise, or even in medical professionals, there's a liability insurance. But other than that, the loss of job cannot be covered through insurance. So what do? You create a contingency fund or an emergency fund. How much should it be? Well, then now link it to the probability of loss of job. How safe and secure your job is versus somebody whose job is highly uncertain, or the source of income is highly uncertain or highly very sure, or how long will one have to wait to get another job? And mostly the answer lies in the safest kind of situation. You may have a 3-month kind of expenses that can be covered through contingency fund. So whatever is your monthly expense, 3 times of that should be in contingency fund. That's the safest side. But on the riskiest side, some people go up to 1 year of expenses or up to 2 years of expenses. And this is why it is critical to do budgeting exercise and know your monthly expenses. If you know your monthly expenses, you will know how much contingency fund you require. But along with that, let's now look at a few other things. If you have a loan, then your monthly outflow goes up to the extent of EMIs. And in that situation, your contingency fund may need to be larger. If you do not have adequate medical insurance or you do not have it at all, then also your contingency fund needs to be larger. So there are multiple ways of looking at it. But if you consider all these factors, then you can get a fairly good idea of how much contingency fund would be required. And similar questions would apply to how much health insurance you will need, how much life insurance you would need, and so on and so forth. We talked about these 4 insurances, so I'm just now going to the next slide. Let's remember Warren Buffett once again and bring out that point: income minus expense equal to savings, or income minus savings equal to expenses. Now, between these two, if somebody tells me that don't spend, you need to save for a better life in future, the chances are there's going to be some apprehension. The chances are that I might have a question: why do I sacrifice my present for a better future? Let's understand and go back to that discussion earlier that we had. All your financial goals for which you are investing, for which you are saving money, all these financial goals are nothing but future expenses. And in that case, the equation is not really saving versus spending. The equation really is spending now or spending later. And what are we spending money for? For a decent quality of life, a good quality of life. So the question is really, what quality of life I want today and what quality of life I want tomorrow. When you start looking at a quality of life and you don't want to deteriorate your quality of life in future, then you can't avoid saving. You can't avoid investing properly. Again and again, this question keeps coming. When you are looking at investment, be clear about why are you investing. And this why is all about the events of life the financial goals, it's not about I want to get high returns, I want to generate wealth, I want to save taxes. These are not the correct whys. Even if I have an objective, I want to create wealth, what will I do with that wealth? So eventually, that wealth has to be consumed by, if I don't consume, my next gen will consume it. And that's essentially means all these whys have one answer, which is how much do you need when for some expense. And these expenses are the financial goals. The standard financial goals that we all talk about in Indian families in particular, we need a house to live in, we need vehicles at various points in time, we may need to upgrade the vehicles, we may need to upgrade the house, the children in the family need to be properly educated. When they grow up, the marriages also involve expenses, and at some point in time when we stop working, the retirement phase needs to be funded. These are the broad 5 goals. Apart from that, one may want to start a business, one may want to do some charity, one may want to go out on vacation or do a vacation every year, whatever. These are the goals. And if these are the goals for which investments are made, then the risk that we need to worry about, the only risk we need to worry about is not getting the required amount of money at the time of that goal. 3 things: required amount or adequate amount, when needed, the time, and not getting. So this not getting is something that is difficult part. I may have a large portfolio of real estate, but when I want to put my son in college, the real estate market may be down and I may not be able to sell that property for a couple of years, by which time his graduation may get over. Money is there, wealth is there, but I can't liquidate it for the purpose for which I had invested. And that risk needs to be considered. So the broad 4 risk factors that financial markets or investment professionals and investors need to worry about are the price fluctuations or volatility, which typically we associate with equity markets. Having said that, even gold prices are volatile. And if you are familiar with the secondary market where debentures and bonds trade, those prices are also volatile. Incidentally, even house prices are volatile, but that's not visible because real estate is associated with another risk, which is illiquidity. In the absence of liquidity, liquidity means you can easily buy and easily sell in a short period of time. In the absence of that liquidity, in real estate, you know that same property, not many transactions take place. Whereas in stocks and gold or silver, people frequently do buy and sell. In the absence of liquidity, volatility is not visible. But when volatility is highly visible, that means that market is sufficiently liquid. Credit, that risk is present when you lend money to somebody, which is really what you do in case of debentures, bank deposits, bonds, etc., etc. You lend money to somebody, and that somebody has promised to pay the principal back after some period, and during the period or along with the principal, that person has also promised to pay interest. Now, this promise is a part of a contract. And when somebody does not honor the terms of the contract, which means either delays the payment or does not pay at all, that is the risk called credit risk. Now, and of course, the fourth is inflation, which is where, while the money is there, the purchasing power of money keeps going down because the prices keep going up in the market. Whether it is food items, whether it is petrol, whether it is clothing, education, healthcare, housing, when those prices keep going up, that means there is inflation in those prices or rupees purchasing power is going down. The interesting part here is many times people come and say, I want something that is without any risk. So let's look at a product where there is no volatility in the price, zero volatility, which means the value remains same. It does not change. There is no credit risk. There is no risk that somebody will not return the money. There is full liquidity. At any point in time, you can access that money. So if you reduce these three risks to zero, where can you keep your money? The only place you can keep your money is in currency notes. Nowhere else. And that means currency notes lying at home, there is no appreciation. In other words, when the prices are going up, the inflation hits that currency note and the value goes down. So if you want to avoid these three risks, the fourth hits you hard. And if that's the case, in personal finance subject, please consider there is nothing called risk-free. You have to take some risk or some combination of these risks. And when you have to take that risk, that means it's a choice, and you can exercise a better choice only when you understand the risks better. So the whole subject of investment management in my mind is a risk management subject and not a return enhancement subject. These four risks versus the three primary investment objectives that any investor may have. And if you combine the three, there is no single investment which is exposed to all the four risks or it does not have any of the risks. And there is no single investment that fulfills all the three objectives. And that is where you allocate your money across different investment avenues or different asset classes, what we discussed earlier called asset allocation. The process of asset allocation goes in line with your choice of risks and your objectives, how they are laid out. Let's say if I've got a very short-term objective, I need money next week, then my primary investment objectives is liquidity. But when I can afford to stay invested for long term, I need protection against inflation. And in that case, my primary objective becomes returns. But if I got an intermediate term, medium term kind of investment horizon, my primary objective may be safety. And I can allocate money accordingly. Just crude examples or just a few examples. As you go along and as you start defining your investment goals, your investment objectives will start getting clear. Based on the investment objectives, you can take an informed choice on which risks to take in what proportion. Just want to quickly highlight one particular risk that is often not discussed as much, the inflation and what it does to us. The more important part is what it does to us. First of all, the inflation number that the government notifies is calculated basis a certain basket of products and services. How much would it cost in 2023 versus how much would it cost in 2024? And the difference between the two is called the annual inflation between 2023 and 24. Our problem is, while the government keeps the basket same for the purpose of calculation, we change the whole basket. A few years back, I was using a two-wheeler. Today, I'm using a four-wheeler. Few years back, I used to go to a tailor shop to get my clothes stitched. Today, I buy branded stuff. And tomorrow, I may buy a premium brand. We completely shift our basket of consumption. And because of that, our own inflation is likely to be higher than the government's inflation number. And over a long term, the impact that it has is enormous. If my inflation is 8% per annum, in 30 years, my monthly expenses would be 10 times of what I'm spending today. If my inflation is 10%, it will take 24 years for the expenses to multiply 10 times. But if my inflation is 12%, it will only take 20 years. And when you consider a long life, which we see these days, I mean, in many families, you will see elders of 80 and 90, and in a few cases, even centurions. When you're talking about that longer life, now imagine what impact inflation can make over a long period of time. And that's why whenever there is a long-term goal, you've got to protect your money from the risk of inflation and choose assets accordingly. Right? So that's the definition of asset allocation. You highlighted a couple of times. I'll just wait for half a minute for you to read it out. The keyword here is your unique situation. Even at the cost of repeating, I'm saying because your situation is unique, the solution in form of asset allocation, the solution in form of insurance, contingency fund, everything is going to be unique to you. The art of asset allocation lies in understanding your needs and matching them with the investment products. Now, these investment products would be associated with certain risks. Within that, you can reduce certain risks. Take, for example, when we talk about price fluctuation, that risk is largely associated with equities. When you invest in a single company stock, it is likely to be far more volatile in comparison to investing across multiple companies. The moment you invest across multiple companies, you brought down that risk. But if those multiple companies also happen to represent multiple industries, then your risk comes down even further. And this entire concept of investing across multiple companies, multiple industries, even multiple geographies is called the process of diversification. That diversification is a proven strategy which can reduce some amount of risk. So while you take some risks, but also adopt risk management measures. Financial goals are about events in life. One of the simplest examples is building an investment portfolio to fund college education for one's daughter. And a lot of times people advise that earlier you start, the better. So there is a hypothetical case where a girl child is born today somewhere, and the parents are very excited and they are also very meticulously prepared. So they say, now let us start investing some money, small amounts, through, let's say, an SIP in a mutual fund scheme, so that when this girl goes to college, we can fund the education through the money accumulated. We said in case of goals, how much money would be required is important. When a girl is born, she would go to college, maybe let's say at the age of 17 or 18 years when you complete the 12th standard. So that to that extent, the amount of time or the number of years is known. But how much money would be required is a function of which college she goes to and which stream she chooses. How can the parents know at the time of the birth which stream the daughter would choose? My point is, financial goals are largely based on assumptions. And when they are based on assumptions, assumptions have a funny habit of going wrong. So along the way, you've got to keep reviewing what has happened to the goal, whether the goal has changed, whether the time has changed, whether the amount has changed. And then you also look at the portfolio, whether because of changing the values, additional investment, redemption, etc., withdrawal, has the risk profile of the portfolio also changed? Are there any weeds in that beautiful garden that you created of your investments? Those weeds need to be taken out of that garden so that all you get is large number of flowers and less number of those weeds. So this review is a critical activity, but this review need not mean that you do transactions. The review could also be like a regular health checkup, medical checkup. Most people, if they are regular in their health checkup, most of the health checkups, the reports suggest that no medical action is required. But you still go and get the medical checkup done. Review is exactly like that. You go and get your situation, your portfolio, your goals, things reviewed. And after that, you may decide whatever we are doing currently, let it continue. There is no need to make any changes. So just to quickly summarize, I mean, it's exactly 1 hour and 1 minute since I started. Just to quickly summarize, the whole subject of personal finances is all about what kind of life that you want to live. And a few years back, I did not realize this truth. But today I can comfortably say that eventually it's not the lifestyle, it's the quality of life that matters more. And the better quality life means you should be happy with less stress. And for that, money plays an extremely important role. The way you handle this entire planning subject or financial planning subject is you start with some contingency fund. We talked about between 3 months to 6 months, 1 year, 2 years, etc., depending on your own situation. Have adequate insurance. We talked about 4 different types of insurance. That's the bare minimum. You also need to insure your property, like your vehicle, your householder's policy, etc., etc. So you need to have that insurance as well. We did not touch upon that today because of paucity of time. Then you create an investment plan to meet those financial goals. The insurance takes care of the negative events that may take place. Investment portfolio helps you achieve those positive events, the events that you want to embrace, or some surety that these events are going to happen. If the events are uncertain, you need insurance. Have a plan to achieve those. Implement that plan and stick to the plan. And at all the places, my sense is many of you may not be able to do it yourself. Please take professional help. It's going to add immense value to your life. With this, we end. Thank you very much. I think there are a few questions which I'll take, but before we go to the questions, this was just a 1 hour webinar. This subject has a lot more. NISM has very recently launched 2 e-learning modules. Both are 3 hours each. One is called Financial Planning Basic and the other is Financial Planning Advanced. Those of you who are interested, you can click on this link and you can note down and look at the modules number 16 and 17. 16 is basic and 17 is advanced. Take the basic module first and then go to the advanced module. As I said, both are 3 hours each, so it's an investment of 6 hours plus there is the learning fees, that the course fees that there is there. But those of you who are interested, they should be useful to you. Yeah, so thank you so much. I really enjoyed delivering this session, and I hope that you all also enjoyed this session as much as I did. Let me just quickly take a look at the questions which are there. Okay, Amanji, sorry, I'll repeat it. I missed your point at that point. You may please repeat what is attributed to Warren Buffett. It is said that Warren Buffett had written in one of his letters to his investors, don't save what is left after spending, spend what is left after saving. Difference between saving and investment. Okay, basically, the way I look at it, and not everybody may agree, but saving is where you do not take investment risks. So you're not really looking at credit risk or volatility risk, but investment is where you take those risks. Investment is done with a purpose. Saving is largely to take care of the liquidity requirement, short-term requirements. So that's how I look at the difference between the two. Any standard asset allocation for moderate risk taker? So Rohitash ji, as I said, these are personal things, so a standard approach may not be suitable. Uh, there are certain tools available online, or else I would suggest that you seek professional help. There are many investment advisors, mutual fund distributors, and many other professionals who can help you arrive at your asset allocation plan. Okay, Amanji, sorry, but I have repeated that, so I'm skipping this. Is there any specific formula for the age of 30, 40 income around? No, Sarangi, I would say it's not so much about the age of the person and the income. It's more about the expenses and the time to the respective goal. A 30-year-old may have many goals in next 20 years, whereas a 50-year-old may be investing only for the third generation, depending on the level of wealth. So everything would change. What would be best option for passive income in this inflationary era? Antarjoji, I understand that you are actually looking at sources of passive income to beat inflation, because you mentioned inflationary era. Uh, the out of the assets, the three asset categories, which is equity, real estate, and commodities, they have the potential to generate returns in line with inflation or more than inflation. Let's say commodities, for example, the change in the prices of commodities eventually gets reflected in the inflation. If food grains become costly, if metals become costly, if petroleum becomes costly, those are the commodities. However, the commodities available for investment for us are only gold and silver. Historically, over shorter periods of time, gold and silver may have often failed to beat inflation, but generally over a 20-30 year period, they have the potential to be in line with actually slightly above inflation, the growth. They don't generate any income. Any real estate, if you're able to get rental income, then that may become a good investment, because rent is also in most places, there is an inflation adjustment every year. The rent may be rising, or what, every 2 to 3 years the rent may be rising, and plus the property value would appreciate, and that's largely in line with inflation. So to that extent, there could be an inflation protection. And of course, the biggest inflation protection comes from a portfolio of high quality stocks, or a good, well managed, diversified equity mutual fund. So these are the things that I would look at. Anything other than that, and then you are actually getting into a business where, if you do not have enough knowledge, it may become not just risky, it may become dangerous. Manojji, there is no registered insurance advisor list that I know of. Because insurance advisors are agents of the insurance companies, and they are associated with individual insurance companies. If there are multiple agencies like insurance brokers, then they maybe that list is available on IRDAI website. But those who are insurance agents, their list may be available from the insurance company and not otherwise. At least I have not seen that list. Should one go for flexible or fixed asset allocation? Saini, these are more technical questions, so I'll skip it at this point in time. This requires a much lengthier discussion. With CBDC, Umashankar ji, the risk of keeping currency at home may be mitigated. You may keep the currency in digital format, but it still is exposed to the risk of inflation or losing purchasing power on account of inflation. Pratham ji, okay, so for this, I may not be the right person to answer simply because there are many questions that must be answered by you before getting answer to your question about where should you invest or whether you need to do SIP or not. So this becomes a very specific question, and the answer must be that specific. Ideally, you should go to a mutual fund distributor or an investment advisor and seek help. Kumar Chinduswamy, how often review of personal finance has to be done? People recommend that it should be done once a year. If you want to do it at a higher frequency, then half yearly is okay, but in 6 months, your situations do not change much. But overall personal finances, at least once in 2 years, you should review. Having said that, whenever there is a major change in life, a transition phase, so let's say a working person about to retire, a working person changing a job, transfer from one city to another, death in the family, birth in the family, marriage in the family, these are transitional phases. At point in time, it's better to patient. What ID between Savarmalji, sir, what ID between passive occupation and active? Oh, no. So passive income and active income. Now, what happens is there's no fixed rule as to what should be the breakup between active income and passive income, because when you start earning, assuming that you not inherited anything, when you start your job after your education, at that time, all you have is active income and passive income is zero because you yet not started investing. You just started earning. And then at the end of your working tenure, when you retire, all you can have is passive income, and because you retired, so there's zero active income. So there's nothing called ideal mix between the two, but eventually you need to go to a stage where your passive income is sufficient to take care of your requirements. What's the source of trusted financial advisors? That's Naeemdeep, very valid point, and thank you for asking this. The investment advisors list is available on SEBI website because these investment advisors are registered with SEBI. Mutual fund distributors, their names are available on the website of MFI, Associated of Mutual Funds in India. Sunilji, add a zero slide. What I meant there was, if your household expenses are growing at the rate of 8% per year, assume that you are running your household for, let's say, 10,000 rupees a month. So your household budget is 10,000 rupees a month. If your inflation is 8%, 30 years from now, your monthly expenses mathematically would be 1 lakh rupees per month. But if your inflation is 12%, then 20 years later, this monthly expense would become 1 lakh from 10,000. So that's what I meant. How to switch from banking to financial planning profile? Is certification and degree a must or banking experience? Now, Anuji, if you want to become a financial planner, you'll have to register with SEBI as an investment advisor, because financial planning comes under that. For that, there are a few requirements. You need to have a certain minimum net worth. If you are registering as individual, then the amount is 5 lakhs. If you are registering as a company, it is 25 lakhs. So not much, but you still need to have. Number two, you need to have a certain years of experience, 5 years relevant experience. So if you have banking experience, 5 years banking experience would count. Then there is a minimum post-graduation is required. And this post-graduation has to be either a 2-year university course in relevant subjects like finance, business management, economics, and stuff like that. Or NISM has launched a 15-month postgraduate program for investment advisors. You can do that, and that's equivalent of post-graduation in as per the CB regulation. And the fourth requirement is certification, for which there are two certifications that you have to pass: NISM Series 10A and NISM Series 10B. Raju, revisiting the investment can be transfer of the funds to some other avenue. Okay, Rajiv ji, reviewing of the investment need not mean a transaction. You to review, like as I said, like a medical checkup. If I go for a medical checkup, after that I need not go through a surgery if everything is normal in my report. So review of investment portfolio is must periodically. Transactions may not be required. Okay, Neha, can you just drop the course link in the chat box? Chiragi has requested. I think that would help. Thanks, Chiragi. That's a good suggestion. Can you tell how ETF different from? So for ETF and other types, I think there is a webinar on mutual funds that was done sometime back. Recording may be available on NISM website. Go to the e-learning module, go to the webinars link on the NISM website, and you may be able to go through it. If it is not covered, I think Neha, it's a good idea to do one session on ETF, because I think I don't know Kunj sir when he did active versus passive, I don't know whether he covered ETFs or not. But otherwise, ETF by itself could be a module that can be done.
Sure, sir.
Okay, so there's an anonymous attendee who said how to manage investment planning for future. Investment planning is always for the future, and some of the steps, basic, initial discussion we did, but detail we skipped. Viveki, how can we take an asset allocation of clients according to age? You can't do it according to age. You shouldn't be doing according to the age. Look at their goals. Look at their financial goals. Okay, Ashalji, so I'm just repeating good loans versus bad loans. Good loans are where either you are increasing the potential of income or you are reducing expense. Generally, I would call them good loans, except in certain other cases where you are getting peace of mind or there is an emergency. Bad loans are one where you are only increasing your future expenses. Sarangi, I'm sorry, I'll not share my phone number. Whether they are planning for some unforeseen expenses like huge legal expenditure in connection with divorce. Well, these are Amitavji, these are individual situations where the individual family members may have a better idea of the probability of this. In certain cases, some insurance products are available. For example, I said legal liabilities. There are liability insurances available for doctors, for directors of companies. Directors indemnity insurance companies can take. So those things are available, which can take care of some of the legal issues. Not all may be covered. Divorce, I don't think there is any insurance available for that situation. Amanji, whatever your age, what kind of life you want to live, which city would you like to live in? what kind of house you would like to live in, what kind of vehicles would you want, what kind of vacations would you want to go for. These could be converted into goals. I'm assuming that you are not married. Your marriage could also become your goal. If you are already married and if you've got kids, their education could be a goal. Sanjit, as I said, a session on mutual fund has already been, a webinar on mutual fund has already been done. You may want to check the recording. My single one-line answer is mutual funds are better than investing directly in shares, simply because in case of mutual funds, at a very, very low cost, you get professional management, professional managers managing an investment portfolio in a disciplined manner, and the portfolio is diversified. When you do it individually, you may not have professional skills, your portfolio may not be diversified, and you may not have the discipline, because you don't have time to do that because you're busy in some other profession. Purushottam ji, the link would be available. You can watch that. PPT would not be available, but the link would be available. You can watch it. NISM's website. It will be available. Okay, there are some questions related to certain regulations which I'm not covering because they don't come into the scope of today's session. Amanji, you want to study more about securities markets, you come to the right place. NISM is full of so many resources. There are e-learning modules, there are webinars, there are certification exams. So you actually come to the right place. Explore NISM website extensively and you'll get many answers. Kasip ji, when passive income surpasses the total expense and liabilities, uh, you can say that you are now financially free, because what financial freedom means is you don't need to work for money. You work because you want to work. The active income doesn't really matter, but whatever is left after your expenses and liabilities, whether it comes from active income or passive income, that should be reinvested back. That will keep making you more and more wealthy and more financially comfortable. Saloni ji, how to calculate how much money I'll need to buy something that is of X amount now, but I do not know the price of it 20 years down the line. So, like my daughter's education, what line she would take, what stream she would take, what college she would go, those are assumptions. Similarly, the rate at which the cost of this item goes over a period, or the inflation in the cost of that item, is also an assumption. So you can start with this amount X, which is today's cost, apply an inflation, let's say 10% per year, 6% per year, whatever you feel is appropriate, or you counsel somebody and put an inflation number, and then calculate the value 20 years hence. But because this is an assumption, the actual inflation is likely to be different from the assumed number. So you've got to review it periodically. Okay, so there's an interesting question. Is mutual fund better or futures and options? Both serve different purposes. Incidentally, some mutual funds also use futures and options. So there's nothing called which is better. Both have their own purposes. You got to handle with care. Can portfolio of investment work to make personal financial plan? Tusharji, portfolio of investment is part of the broader aspect of investment planning, which is a subset of personal financial planning. So as part of your investment planning, you create a portfolio of investment, and investment planning is a part of personal financial planning. So these are not alternatives or one works for the other, it's part of it. Okay, can buying a land, I'll not comment on land. I'm not sure of how that economy works. My thoughts on ULIP plans, well, I'll reserve that comment. These are investment and insurance combined unit-linked insurance plans. So they are put together, and that's all Dhruv. I'll not go beyond that. Sachin Sharma ji, NISM keeps conducting some sessions periodically on career counseling. Also, there are some webinars on certain courses that they have. You may keep visiting NISM website for further details. You can download certain brochures or go through the entire site to understand how NISM can help. Suhas Murali, which type of insurance is better along with, as I said, life insurance, health insurance, critical insurance must. Pushpit ji, investing would generate passive income. So there is nothing, there's no difference between the two. But my suggestion to all college students is don't start investing first. A lot of college students make the mistake of dabbling into futures and options first, or looking at exotic stuff first. Don't do that. Start with what is simple. Start with the basic, and the basic is financial planning. Once you understand financial planning, then build the knowledge on various investment avenues and various investment products. Don't start the other way around. uh, Pradyumanji, money market, debt-oriented mutual funds are good for certain purpose, and you got to choose the funds when they are able to suit your requirements. But are they good or bad? There's nothing in isolation that I can say. They are good for certain purpose. They may not be good for certain other purpose. Jaswant Singh ji, any book for learning financial planning, uh, NISM 10A, Series 10 and Series 10B certification examination workbooks are, very, very detailed books specifically written for financial planners or investment advisors, keeping them in mind, and excellent books. Ritvik, how does one inflation in a particular field say clothes? I didn't understand the question, but mostly you'll take some number, start as an assumption. No need to go item wise. So if you're looking at household expenses, look at inflation on household expenses. No need to look at individual items. I use the example to explain a concept that the government published number and my inflation could be very different. Manoj Patil ji, how many types of assets should be there in a portfolio? So there are broadly 4 assets. If you want to add two more, so we talked about equity, bonds, real estate, and commodities. So in commodities, you have gold and silver. If you want to add two more, the fifth asset could be cash, and the sixth asset could be international investment avenue. So in international, you can look at international stocks. So that way, it's really all that you can have, and you can invest across this. And then there are sub asset categories below that. So within equity, you will have large cap, small cap, mid cap, debt. You will have government debt, corporate debt, etc. But keep in mind this 6 broadly. That's enough. Prakash ji, is it okay to take loan for investment in commercial property? I won't answer specific questions, but if you are taking loan for a commercial property which you are going to use for your own business, that's business financial planning. It's not personal financial planning. You are actually taking a place where you can earn money from. How to Manoj Kumar ji, how to get license from RBI for investment advisor? No, you get this license from SEBI and not RBI. Go to SEBI website. There is a entire detailed process, application forms, documents required. All the details are available there. Sahilji, I'll not get into this. This is slightly complicated and beyond the scope of today's topic, whether a mutual fund distributor can work as financial product advisor and planner. So it requires a different discussion altogether. Anand Chetty, again, this is a regulatory question about income of financial planner. So let's skip this for the time being. Yashwant what is your advice to a 25-year-old? Learn as much as you can. Those recordings are available. You go under the webinar tab and there are recordings available at the bottom. Many are repeats, so I'm not taking those. Amitavji, whether it is wise to avail housing loans to claim loss of income in paying interest under Section 24. Uh, you know, you're starting with tax planning as the objective. My sense is, do you want a house and do you need to take a loan for that? If yes, then take a loan and then claim all the benefits under Section 24 and if available under 80C, if there is a limit available. But don't take a loan only to save tax. Shiva Kaviji, you are asking a question about a specific stock. Please never do it in any public forum. Please never ask a person who doesn't know you. If you know somebody who has been dealing with you as a professional and the person is your advisor, then do it. Otherwise, don't ask this question in public to anybody. The answer may come without knowing you, and it may or may not be appropriate for you. Rajiv Sharma ji, mutual funds performance. There's a specific webinar, separately done for mutual funds. So you may just check that out. Purushottam Basuji, which is the safest fund to invest in mutual funds for a beginner? Uh, as I said, there are, when we talked about the four risks, it's a choice that you want to make. What risk would be appropriate for you may or may not be appropriate for somebody else. What is appropriate for you in one situation may not be appropriate for you in another situation. So that way, something that is universally safe, no such thing exists. Vijay Sharma ji, the financial planning basic and advanced module courses are not, approved by the regulators. They are not for the professionals. They are for the financial people interested in financial planning. For the investment advisor registration, you got to clear NISM Series 10A and 10B certification exams, two examinations. Apart from that, you also need to be postgraduate in the relevant fields, 5 years of experience, and you've got to have a certain minimum net worth as specified in the regulations. Rishabh, what is the ideal amount of SIP for a middle class man who wants to grow money within a year? Uh, you can't get correct answer to this question. First of all, why only 1 year? Grow to what extent? Middle class, how do you define? What is the purpose for which the investment is being made? Without these questions, or without specifying many of these things, your question would not be answerable. Subbarayuji, again, you are also asking a very specific question, so I'm skipping it. Anup Kumar ji, which is the best age for retirement? The day you decide, that is the best age. I don't think somebody else should take decisions on your life. Durgesh Thakur ji, if someone is already stuck in bad loans, then what is the solution with unstable job? This is a slightly tricky one. Explore loans where the interest rates are lower, if there are anything available. If you have an unsecured loan, the interests are likely to be higher. Can you get a secured loan by, against, let's say, a portfolio, against the gold that you may have, something of that. So the interest cost comes down. And when interest cost comes down, automatically your burden reduces. So you switch over the debt from costly debt to lower cost. And though the job is uncertain, whenever you got surplus, first allocate that towards repayment of loan. Kanaji, which mutual funds do F&O? Do F&O? No, I don't mean they do F&O in the sense that they do trade in F&O. There are no hedge funds available, but there are mutual funds are allowed to hedge their portfolios. They are allowed to do arbitrage. They are also allowed to replicate the index through derivatives. So to that extent, they use future contracts or options contracts in their portfolio for certain purposes. But they don't do F&O, or there are no hedge funds per se. Dhruv Shah, term insurance or ULIP, which is better? If taking a risk cover is the objective, then term insurance is better. But if you want to combine insurance and investment both, then term insurance, you don't get anything. There's no investment component there. What about tax implications in financial planning? Any tips? Some of the tax planning ideas are covered in the financial planning basic and financial planning advanced modules, Joby sir. So you may want to just take those courses and see. Importance of AI in financial planning, different subject altogether. Uh, I hardly have any knowledge on AI to be able to comment. Critical illness insurance is different from medical insurance. Yes, Akhileshwarji. Venkateshanji, there is a specific question. I don't want to answer that. Not appropriate for me to answer. Sarang Kocheji, you may go through SEBI's website. The regulation specifies everything about becoming a financial planner. Rishabhji, I'll skip talking about global deposit and receipt. It's beyond the scope of today's topic. Lokmanji, this 15-month course is a weekend course. There are 3 lectures of 3 hours each, one on Saturday evening and 2 on Sunday. So anyway, these are weekend courses specifically for working professionals, salaried employees. Amit Kumarji, what does the customer look for in a good financial planner? Again, beyond the scope of this subject, if you are a consumer, you should be able to answer. If you are a planner, then you might know through your customers. Kailash Taki, which one is better, ULIP or SIP? They are completely different products. Actually, ULIP is a product, SIP is a process, investment process. It's not even a product. Manoj Maruti Patil, ji, stocks versus mutual fund, which will give better returns? Well, I wish I knew the answer to this. Souvik Ghoshji, should college students consider? There's nothing specific for college students. I mean, the principles remain same whether you are a college student or you are a college principal. Whether fixed deposit would help you achieve your objective, that should be the question. Dr. Sanjay Kumar, difference between financial planning and financial analytics. Financial analytics would, again, I am not sure about that subject, but it deals with a lot of data and analysis of that data, whereas financial planning is more about an individual, whereas financial analytics may involve data across many individuals, across time periods, across a lot of things, whereas this would be more specific to a family or an individual financial planning. So that's how I would maybe understand this. Sarangi, any fees to be paid to NISM to become a financial planner? No, you to pay fees to SEBI. The only fees that you need to pay to NISM is for those 2 certification exams, the exam fees. And if you take that 15-month postgraduate program, then the education fee for that program. NISM doesn't take any other fee in any other form. Anmoji, sorry, I didn't understand your question. I'm skipping it right now. Which NISM certification would you recommend to a fresher for a job? Which job? And there are different certification requirements for different jobs. And NISM, I think, has got some 25 different certification exams. Okay, I think we'll just we should close it now. It's already 5:45. Pratima ji, as a beginner, should we start with mutual fund or direct stocks and equity investing? Mutual fund is better. A lot of questions are coming from mutual fund distributors. I think that regulatory aspect I don't want to cover in today's session because it is all about personal financial planning. Dr. Poonam Lohana, is it possible to earn 1 crore from 10 years SIP through mutual funds or direct investment? Incidentally, both are possible. You just need to, invest accordingly. So that's about it. But this question actually, whether it is possible or not, it's in, you know, not enough details are available. So otherwise, 1 crore is possible. You only need to invest more amount. That's about it. I think with this, let's end this session. There are a lot of questions more on the regulatory aspect. So I don't want to get into that. There are some very, very specific questions on financial requirements or some specific advice kind of questions. My simple request to anybody seeking any specific advice that I've got so much money, where should I invest? I've got so much money invested this way, whether it is good or bad. My sincere request to you all would be to consult a professional who's in that field, practicing in that field, whether it is an investment advisor, a mutual fund distributor, an insurance advisor, a retirement advisor. Please consult the professional and take an opinion. That professional will assess your unique situation and give an answer. These questions asked in general forum may give you answers which might be right for somebody but may not be appropriate for you. So with that, let's end the session. Thank you so much. I hope this session was useful for all of you. Thank you.
Thank you, sir. I would like to place my sincere thanks to our today's speaker, Mr. Amit Trivedi, for sharing his insights with all the participants, and thanks all the participants for attending this session. Thank you all.
Thank you.